Ladies and gentlemen, good afternoon. I'm very grateful, of course, for the invitation on this panel. I would just start with a very quick disclaimer. I see a lot of my fellow council colleagues in the room, of course. It's obvious, but I want to make clear that I do not speak on behalf of the council. I can only speak for France, obviously, and I can only praise the efforts of the Bulgarian presidency to bring this package to an agreement as soon as we can. So for France, it is crucial, of course, that we complete the banking union, not only for the sake of the project in itself, but also because banking union, together with the CMU, belongs to the broader agenda of the deepening of the economic and monetary union, which has been alluded to by Mr. Karas and Martin from the Commission as well. Deepening of the EMU, on which our leaders intend to make concrete progress at the summit in June, of course. So we should move forward as soon as possible on risk reduction and on risk sharing in parallel. As you know, the risk reduction package was already on the agenda of the ECOFIN Council in March, but as you know, the political situation, also in certain member states, did not allow us to find an agreement back then. But on substance, we're convinced that the Council is actually not far from an agreeable balance and that the landing zone is at reach in the latest text from the Bulgarian presidency. Of course, we as France don't like it all, but that's the point with a compromise. So today, I will not enter into the nitty-gritty details of the package, but I would invite you to take a step back and consider three key political principles which actually overarch the French positions on each and every piece of financial services legislation, not only in banking. And those three principles are the following. First, to ensure a level playing field at the international level, so between EU institutions and foreign institutions. The second principle is level playing field within the EU, between EU institutions active here. And the third principle is recognizing the progress in the EU institutional and supervisory setting and recognizing these progress with concrete consequences in the prudential legislation that we craft. So let me come to the first one, level playing field at the international level. In a highly interconnected world, global financial stability, building on international standards, is no doubt a common public good. But at the same time, we cannot ignore the implications on competitiveness of financial institutions in different jurisdictions. So the very concrete example we can take of this principle in the package is, of course, the Frtb Standard. Let Basel finalize this standard before we make it EU law. This is as simple as that. France has always pleaded for not including the standard in the legislative package, given the long-known uncertainties in other jurisdictions' intentions to implement the provisional January 2016 version of the FRTB. And when I say other jurisdictions, this is not only the US, it's also Canada, it's Australia, it's Singapore, it's Hong Kong. And in addition, since the Commission proposal, we've had a game changer, the final Basel III statement by the GHOS in December last year, which recognized for the first time publicly that a significant review of the FRTB standard is underway. Therefore, there is no binding standard today. We will have one likely at the end of this year. And therefore, this final standard would be implemented only in 2022, so postponement. Now, the issue is obvious to us, but to the general public. Is it good regulation to include in CRR the provisional, outdated January 2016 version of the FRTB? Even with long transitional periods, would the transitional periods make the trick? Whereas we all know that this standard is in the process of being recalibrated in Basel and Basel will never require the implementation as such. So picking up on one of Mr. Karas' comments, I would like to underline that the review underway is actually not only affecting internal model banks, it's not only the P&L attribution test, which is often mentioned, but it's also the standardized approach, which is under review. So if Europe front-loads the implementation of the outdated 2016 standard, it would be an unnecessary burden for all banks, not only internal model banks. So given the likely impact of FRTB, we think it's of the utmost importance that Europe alone does not rush in implementing this provisional standard at the expense of competitiveness of EU banks and ultimately at the expense of the financing of the EU economy. So FRTB is a typical example of France's first overarching principle, which is international level playing field. Moving to the second principle, which is level playing field within the EU and between EU institutions. The key principle for us here is same business, same rules. So obviously France is open to discuss the possible administrative burdens that CRD may entail and look for ways to mitigate such burdens. But essentially, this should be limited to adapting the reporting, the disclosure requirements, provided, of course, this does not come at the expense of supervisors' ability to do their job and of the public to receive valuable information, be it investors but also clients, even in non-listed banks. But what's very clear, as Mr. Carras said as well, France cannot accept proportionality is used to introduce less prudent requirements for smaller banks. Even if proportionality is even worse, if proportionality is used as an argument for blanket exemptions from the single rulebook. Indeed, smaller and less complex banks is not always less risky. Actually, European experience in the last 10 years is that banks facing the highest loss rates and often receiving public bailouts were actually rather small and retail-oriented. We have a very enlightening study from CEPS. I don't know if there's anyone from CEPS in the room, but we have a very enlightening study from November 2015, which was called How Expensive Is It to Resolve a Bank? And it showed that the peak losses, for example, peaks above the famous 8% total balance sheet threshold to access the resolution fund, those peak losses did not happen in G size, or not even in many O size. Banks with peak losses often had balance sheets of a few dozen billions, or even a few billion euros. So coming back to the principle, any simplified approach to the prudential requirement, be it an SFR, be it credit risk, or any other standard prudential requirement, must be demonstrably more prudent, So this is a concrete example of that level playing field concerns within the EU. And by the way, the same business, same rules applies, of course, to banks, but it is also valid for other types of institutions which carry out bank-like activities, and I have in mind investment firms, but this is not a topic for today. The third principle I wanted to mention is recognizing the progress of the EU institutional and supervisory setting. So let's remember why we created the banking union. I have three main reasons in mind. First one is to break the vicious circle between banks and sovereigns. Second is because centralized powers would avoid the risk and weaknesses of national authorities protecting their banks. And the third objective was to create a genuine single market for banking, allowing more efficient financing of our economies. And having the broader economic and monetary union in mind, I would like to insist that fostering cross-border integration of the EU banking sector is also a way to improve resilience to asymmetric shocks through private risk sharing. So to achieve this, we have collectively given up substantial sovereignty to a single supervisor and a single resolution authority. France has 90% of its banking sector directly supervised by the ECB, and this is a much higher level than in a number of other countries. And we accept the loss of sovereignty that this entails, because that was the whole point of the banking union. So the plea now is, let us not stop in the middle of that process. And we're worried that in spite of welcome efforts by the Commission in the initial proposal, there is a risk of unraveling some of the progress we have achieved by giving the power back to national authorities in certain instances, instead of encouraging lifting the obstacles to free movement of capital and liquidity. And well-known examples are, of course, the resistance to cross-border intragroup waivers, which Mr. Carras also mentioned, the prepositioning of internal MREL, or some of the new macroprudential or extended macroprudential tools that have been discussed. So the question is, how is this really consistent with the banking union project? At the very minimum, in France's view, progress in the banking union must be recognized when it comes to assessing the systemic nature of banks. In the calculation of a bank's systemicity score, a transaction between a bank in France and its subsidiary in Germany, for example, is considered as risky a transaction between a bank in France and its subsidiary in Honduras. So no offense for Honduras, of course, but does it really make sense while we're building the banking union? So our plea is simple, true. The banking union is not complete yet. We should work towards that. But significant progress has been achieved already. So we cannot be legislating on CRD5, CRR2 in 2018 in the same spirit that we used to legislate on CRD4 and CRR back in the time where the SSM and the SRB were not in place. So as a conclusion, there's no denying that what we have on the table is a complicated technical package. But in the end, the political trade-offs boil down to simple overarching principles. And today I have outlined the three most important for France. With these principles in mind, France trusts the Bulgarian presidency will find a balanced agreement, hopefully in May, so that the Council can engage into trilogues with the Parliament as soon as possible. Thank you for your attention.